We are good to go here with our preview of Exam3. And as always, what I'm going to say in this preview is no guarantee of exactly what's going to be on the exam. Things may change a bit, but the exam is pretty stable right now. So I think this will be a pretty good preview for you. So one of the first things we started with after exam 2 was looking at risk probabilistically. And we looked at, in particular, Bernoulli distributed types of risks and normal distribution type of risks. With the Bernoulli distribution risk, we only looked at one case. We had some risky bonds that were going to mature in a year or 2 years. They were zero coupon bonds, so you weren't going to get any cash until the bond matured. And I gave you a little table that said, what's the promised cash flow you're going to get when the bond matures? That's what you're going to get if all the contract stipulations are met and everything works perfectly. What's the cash you expect to get if the company has to declare bankruptcy? What's the probability of each case? And what's the expected value? If you keep betting on bonds like this 100 times on average, what would you get, right? So with a table like that, there could be one thing missing. I could leave out one of the probabilities. I could leave out the cash you get in the worst case. I could leave out the expected value. Since you know everything else, you know how to compute that. So we did some examples of that in class and in the homework. And then while we were talking about measuring risk in various ways, we talked about value at risk. And you didn't have to do anything numerically with value at risk, but we had to understand it conceptually because the Fed uses it, Jamie Dimon uses it every day at JP Morgan Chase. Very, very common. So value at risk says there's a 5% chance that in any given period, we're going to get the value at risk return or worse. And the way we understand that graphically is if here's the probability distribution of all our returns, the value at risk return or worse is over in this bad news left tail, and it represents 5% of the area under the distribution, which corresponds to a 5% probability. So if we're measuring our return periods in years, we'd say that there's a 5% probability that we're going to get the VAR return or worse, anything down in this left tail, once every 20 years. Why once every 20 years? Because that's 5%, right? If we're doing monthly, it would be once every 20 months. That's pretty much all we needed to know for value at risk, just conceptually how it works. We did spend some time looking at measuring risk of exchange-traded fund returns or stock returns, and that's where we said the future looks like the past. We get a long list of historical returns, get the average, get the standard deviation, and then we say magically these look like they're normally distributed. Going forward, we'll use the historical expected value and standard deviation. We'll say these returns are normally distributed. I definitely will not ask you something like, here is a list of 20 years worth of returns. What's the expected value and standard deviation? We'll leave that for your stats class, but I will give you an ETF and say, if you think the expected value is 8% and the standard deviation of returns is 20%, and I give you a nice normal distribution graph, then I could ask you questions like we asked in the homework and like we asked and answered in class, something like, what's the probability that in any given year the returns of this ETF will be between minus 10% and 30% or something like that. So those are questions we did a bunch in class, we did in homeworks, and you should be able to do on exam 3. When we were looking at risk probabilistically, we also looked at that quantity beta, right, which came from the linear regression between the returns of an ETF we're interested in or a stock we're interested in versus the returns of the market. And we noted a little bit farther on in our CAPM model, where we're getting the cost of equity capital, the RE, we said that the discount rate you should use for stocks or valuing an entity to shareholders is RE from the CAPM model, where that says RE equals the risk-free rate plus the difference between the market rate and the risk-free rate times the beta, and then that gives us our CAPM return. And the problems that we saw with that were that the R squared for the regression that gave us beta was often really bad. Okay, so it meant our estimate for beta was really bad. So you might be asked something like, what are 2 or 3 things, let's say 2 things, that make CAPM a bad estimate of equity cost of capital, how to discount back free cash flows for stocks? One would obviously be the whole thing is based on the future looks like the past. That may not be true. And another is that the R squared of the regression that we use when we're computing beta might be pretty bad, right? So those are a couple of criticisms that we had of the CAPM model. We use it anyway. Why? Because as we saw, at least 70% of the CFOs, the hedge fund managers, the private equity firms, the investment banks use CAPM anyway. But we need to know that it's not always great. So you should be able to, if I give you a beta, a risk-free rate, a market rate, you should be able to compute CAPM. It's an easy equation. If I give you everything but beta, you should be able to solve for beta. And then we spent some time looking at the awesome power of diversification to make a portfolio of exchange-traded funds behave awesomely well. In particular, we looked at a portfolio of 2 ETFs, 50% in one, 50% in the other. One was pretty good. I think it was the Spiders. One was pretty crummy. It was a commodity ETF, had a lower expected value return, had a very big standard deviation, very big spread of its normal distribution curve. And then we said, how about a portfolio of 50-50? And you would expect that portfolio to be pretty mediocre. But because the commodities were very poorly correlated to the S&P 500, to the Spiders, what we found mathematically was the properties of the 50-50 portfolio were pretty great. We'd get the average return between the two, expected value return, and the standard deviation, because they're poorly correlated, was less than even the S&P 500. So the lesson is you can mix things together with something good and something that looks mediocre and get the synergistic effect because of diversification and correlation, that the performance of the things mixed together is much better than either one alone. And we did that mathematically. We had an equation for that for 50-50 portfolio with 2 ETFs and a correlation coefficient. So you should be able to do that. And then we sort of jumped out of probability and statistics and into thinking about things at the entity level. And for the rest of the term, we've been thinking about things at the entity level. And one of the first things we looked at was the effect of the tax shield. And we found one of the reasons that if a project is worth doing, it's worth levering, is because you get this tax shield effect. So in other words, if you lever up a firm, you have a firm with no debt, you give it some debt, now all of a sudden it has an interest expense of, say, $10 million that wasn't there before, but we find the hit to net income may only be $6 million or $5 million or $7 million. That's the tax shield effect, that even though you have that additional expense for paying interest, that doesn't trickle down completely to net income. And that's what helped us get a higher ROE when we lever up firms, if it's a good project. We saw from Musk, for example, at least using our analysis, what that was telling us is it's not a good project, so it's not worth levering. And then we started trying to, actually, before I get to that, the effect of on net income due to the tax shield is going to be the interest expense times 1 minus the tax rate. So in other words, if we lever up a company, it now has an interest expense of 10 million. The effect on net income is only going to be 1 minus the tax rate times that 10 million. So that might be a helpful thing to know. So then we started thinking about discount rates for free cash flows for entities. And the first thing we noticed is that for an entity, it has 2 costs of capital or 2 discount rates we have to think about. The first was for debt, and we called that the pre-tax cost of debt capital is literally just the interest that the company paid in the year divided by the beginning of the year debt. How much interest did they pay on the debt they had in the beginning of the year. That we called RD, and that was our pre-tax cost of debt capital. We found also companies have a post-tax cost of debt capital, and that's just 1 minus the tax rate times the pre-tax RD. We also said companies have for equity, they have a whole separate cost of capital, RE, and we computed that from CAPM. And we said, we know CAPM kind of sucks, but everybody uses it. We don't have anything better. Those of you going into finance in your advanced courses, you will learn better things. But for us, and for 70% of the people in the real world, we're going to use CAPM. So the cost of equity capital, we typically measured with CAPM. And then we went on to say when we're evaluating entities, we might want to evaluate how much they're worth to just shareholders or how much they're worth to a team of shareholders and lenders. That would be all financial stakeholders. All financial stakeholders is defined to be the lenders and the shareholders. So to discount back free cash flows that we expect to be getting when the whole team goes in and takes over a company, what did we have to use? Not RD, not RE. We had to use the weighted average cost of capital, the RWAC or the WACC. And we had a really simple equation to compute the WACC, right? That was 1 minus the tax rate times the pre-tax RD times the weight of the debt plus RE from CAPM times the weight of the equity. So you should be able to compute the weighted average cost of capital. And with all of that stuff in our pocket, we looked at only 4 scenarios to evaluate the worth of an entity. We looked at what's the worth of an entity to shareholders in 2 situations. One, when the firm is going to live forever in steady state, and we're going to be around forever to enjoy that. And in that case, the present value of all the future cash flows we expect to get from the firm was just its net income divided by its equity cost of capital. We compare that to what we have to pay to buy 100% of the shares, and we're done. Either it's more or it's less. If it's more, NPV is positive, go for it. If it's less or equal 0, NPV is either 0 or less than 0, don't go for it. The second case we looked at for valuing the firm to shareholders only was buy, manage, sell. And we did that with a steady state firm. So the cash flows that we get are the same every year for as long as we own the firm. They're always equal to net income, right? And that income never changes because it's a steady state firm. So we get the firm, let's say we own it for 2 years. We get a net income free cash flow after 1 year. After 2 years, we get another one. And then we sell it the next day. We sell out all the shares of stock the next day. So now we have 3 cash flows we get in the future. We have to discount each one back to T equals 0 using what? Using RE, because we're talking about shareholders. And then again, we just compare that to what we paid for the firm. And if the present value of the cash flows we get back is greater than what we paid, go for it. If not, we don't want to do it. So the 2 scenarios that we had for the whole debt and equity team are very, very similar. We considered one case where the firm is going to go on forever, and we're going to be around forever to enjoy that, the debt equity team. So in that case, typically, we took a firm that had no debt, and we bought all of its shares. But the equity team, for example, bought only half the shares with its own money. That would be E. So let's say we're buying a firm with no debt for $100 million, and we have our team. And we decide, the team decides, well, half of the $100 million is going to come from the equity folks. That's going to be their own money. And half of the $100 million is going to come from the debt folks. And they're going to lend the company $50 million, and the company's going to have to pay interest on that. So we recapitalize it, but the prior owners get their $100 million. Then we own that firm forever until hell freezes over. What's the present value of all our cash flows? It's the NOPAT, right, instead of net income. What do we discount by? Not RE. We've got the team. We discount by weighted average cost of capital. The final scenario that we looked at was, again, for the whole team. We're going to come in at T equals 0. We're going to recapitalize the firm. We're going to lever it up because we know that if a project is worth doing, it's worth levering. So we change its capitalization. The firm is still worth enterprise value $100 million. It's just now 50 is in equity and 50 is in debt after we take control at T equals 0, right? And then we own the firm for, let's just say again, 2 years. Heads up, it might be 3 years on the exam, right? It might be 1 year, but let's just say 2 years here. What are we going to get? We're going to get a no-pat free cash flow after 1 year, a no-pat free cash flow after 2 years, and then we're going to exit the next day. What do we get when we exit? We get two things. We get the total amount of shares times the share price that we exit with, but also remember we got the team now. When we exit, the team calls in its debt, so we get the debt principal back. So in our case, we get that 50 million back. So when we exit, we get whatever we sell the shares for, plus the loan is called, the loan is due, we get the loan principal back. And all of those cash flows, those 1, 2, 3 cash flows get discounted back to T equals 0 at the weighted average cost of capital, because we're talking about the team. What do? We compare that to what we'd have to pay today to control the firm. If we're going to get back more in present value terms than we put in, we go for it, positive NPV project. If not, negative NPV project, and we don't go for it. Is that making sense? And I think you can expect absolutely not more than 2 of those scenarios on the exam. And I will, by tomorrow night or early Saturday morning, I'm going to give you guys an update about the podcast and things like that. And watch for that. That'll be an announcement that'll also be emailed to you. Watch for that, because in that, I'm going to say focus for chapters 15A and B, focus on perpetuity situation for shareholders only and buy, manage, sell for all stakeholders, and don't worry about the other 2 scenarios. So that will help cut down your studying a lot. Right? So watch, be careful for that announcement. That should be my next announcement if all goes as planned, but it will be coming before Saturday lunchtime. And then the last thing that we talked about before we got to pro formas was the chapter I was thinking of omitting, but so many of you were so excited about this idea for companies worth levering, worth buying, it's worth levering, but what's the optimum amount of leverage? So many of you asked that and were so dying to know that I had to put in this chapter. But it was a very short chapter, and the answer to the question is the perfect amount of leverage measured by D over D plus E is the amount that gives you the minimum WACC, the minimum RWACC, right? The minimum weighted average cost of capital. So how did I test you on that? I gave you a little table with D over D plus E equals 20%, 30%, 40%, 80%. And I had the WACCs for all of those there. And I just said, which one has optimum weighted average cost of capital? You look up which one has minimum WACC. You see that's 30. That's your answer. That's all you need to know pretty much for that chapter. But you do need to know, again, how to compute weighted average cost of capital if you have all the numbers to do that. And then finally, we finished up with pro formas. Expect something very much like what we did today.